Welcome back. Today we're talking about property portfolio diversification, why putting all your eggs in one basket can limit your growth, and how spreading risk across locations, property types and market cycles can create a more resilient portfolio. Whether you're starting with your first investment or scaling a multi-property portfolio, diversification is not just about owning more properties. It's about owning the right mix of assets that can perform in different market conditions. So if you want to reduce risk, smooth cash flow, and position your portfolio for long-term success, you're in the right place. Today's episode came about after we received this question from a listener. The question is, how many properties do I need before my portfolio is considered diversified? To help me unpack this is Robin Ram, Property Advisory and Acquisition Research Manager at Momentum Wealth. Robin has decades of market experience, so he's seen all kinds of diversification over the years. Welcome, Robin.
Great topic today, Damien. Thanks for having me.
Glad to see you. Now, let's talk about diversification. We're going to cover that today in quite a lot of detail, but broadly, what does diversification mean?
For most investors, it's making sure they're balancing their portfolio over time for assets that will go up and down with the marketplace to give them a broader return rather than having everything in one marketplace subject to that marketplace's timings.
Yeah, and that's really important. We'll get into that today. And look, residential property in particular is hard to diversify, isn't it? Because it's such a big lumpy transaction and a significant amount of money. And that's, I guess, why it is, if you're going to keep building your wealth through property, why diversification is even more important.
That's correct. Yeah, a lot of investors, where their first purchase, will buy in an area they're familiar with. So they may already have an asset in a certain suburb. They may buy in the same suburb, or it might be an adjoining suburb, but they feel comfortable with that. They may know a few salespeople in those areas who say, look, this is an excellent property. And before they know it, they've just bought two properties in a similar sort of marketplace. So diversification can start with just having an asset, which may be your primary place of residence, and then looking to the same city that you're in and going, look, let's go to the other side. Let's go somewhere different where I can be exposed to a different style of asset.
While we're on that topic, let's get into geographic diversification. Now, you and I know that a lot of people will go out there, they've got a home, and they like to buy something they're familiar with, and they buy their investment property almost in their own backyard effectively. And that's certainly risk, isn't it, as we just said, because if something happens to that particular suburb, let alone the broader city, they've got all their eggs in one basket effectively.
That's correct. And if you happen to be buying and living in an area that may not be the best suited for long-term capital growth, which you may be after, you've just exposed yourself to two properties that may achieve better yields for you, but not the same sort of growth level that you're after. So having a different style of product away from where you're at will already start that process for someone. So looking at your land size, looking at the style of property that you own. Are you living in an apartment? Great. You may be wanting something different completely, looking for something underpinned by a good portion of land. Or if you've already got that inner city good portion of land, you may choose to go somewhere a bit further out and get something with development potential that you can build on. So there are different styles of properties depending on where each person's at.
And in the geographic one, so look, I mean, it's not just necessarily in the same city. It can be going into state. Now, that's I think some people are hesitant to do that, but it might well be that you go to another capital city or regional area around Australia. Yeah,
I feel like 10 years ago in real estate, not many people did anything out of their comfort zone. And with the way technology's been going, it's more and more easy now to get yourself into a marketplace that you may never have set foot on the ground. We work with a lot of clients who are purchasing in cities where they've never even visited those cities, but based on what a buyer's agent can do for them, or based on the research and the communication that's available online, they're now feeling a degree of comfort where I can buy that and I have a broad understanding of what I'm looking for. So it's made it more and more common now to be able to diversify, which is a really good thing.
And it is important because across the country, the markets don't go at the same rate. They're quite different, and we've seen that through even the last 20 years. We saw during 2010 to 2020, markets like Perth didn't really do anything at all. And then we saw post the COVID era, markets like Perth, Adelaide and Brisbane performed really strongly, and Sydney and Melbourne certainly performed less. So it's really important people understand that, isn't it? That markets don't go all up at the same rate.
Exactly. So if you may have two or three properties in the same marketplace, it makes sense to actually be in a different marketplace now. So once the asset in that marketplace has gone through its cycle, the other one may just be beginning its cycle there. So this one will start to plateau, the other one will start to pick up, and your portfolio is still naturally increasing over time because you're subject to different market cycles.
Yeah. And we spoke about type of dwelling and just some of the reasons you might want to diversify out of the buying exactly the same dwelling every single time you invest.
Yeah, when people come and see us, a lot of people don't know what to buy and where to buy. So they're looking for that guide. It's going, I want an investment property property, but what should I do? So the guidance process for us is, are you looking for capital growth? Are you looking for yield? Are you looking for a blend of the two? Do you have money you want to spend into the asset to actually do it up a little bit, to have a bit of a gain? Are you looking for potential developments in the future? So it's narrowing down what someone's looking for their ideal investment, and then helping them achieve that, because a good investment is not only going to perform for them, but it's also an investment that they're more likely to hold. Too many people buy something and then sell it because it doesn't perform like they thought it would in 1 or 2 or 5 years, and then they've opted out, and the entry costs and exit costs just wipe up too much of that money. So it's finding out what are you looking for, and then with that you can then go, okay, I have the risk appetite for something that I may choose to develop in the future. No, that's not on the cards. I want minimal maintenance, I want minimal expenditure. Great, so we'll find something that still has good land portion, but maybe not so high strata fees that could be associated with that. And then it's finding that balance for the client, because you're diversifying them, but you're also helping them buy something that they feel comfortable to hold for that long term.
And we spoke about, going back to the geographic diversification, we spoke about obviously the markets don't go at the same rate. They go up, and across the country they're going up and down at different rates of capital growth. But what are some of the cons of investing in another capital city?
The biggest risk, I would say, for most people is the comfort level. So they understand broadly their own marketplace to a degree, and they feel they can drive past it. They go to another marketplace, and if that asset is not something that they're familiar with, they can't drive past it, they're not too mindful of how the compliance side of it works. Before they know it, they've bought the idea of an investment in another city, but not really research what it's going to cost them and how do they get out of that investment in the future. And a good example would be right across Australia, the Residential Tenancies Act differs for every single state. So there are some friendly legislations like Western Australia that if you happen to purchase a property and your tenant is not the best track record of paying their rent on time, a little bit too much damage on the property, for example, at the end of that lease, you do have the option to exit that person. In another city like Melbourne, for example, that becomes much harder, where as long as the person's catching up and paying the rent, getting them out of that property, unless you're moving into that place or you're doing a substantial renovation, becomes quite difficult. So as an investor, that means for you, you need to be mindful of the risk that's there, but also have the cash flow to be able to hold through that period. That if you do have maybe 1 or 2 months where the tenant's a little bit behind, you're holding on through that process and not going, this is too difficult, I'm out, and then that investment should never have been yours to start with.
And all residential tenancies laws are in favour of the tenant, but as you mentioned, they vary around the country, and Victoria has one of the most pro-tenant legislations that is there. I think importantly also, it's also the minimum standards and other things that maybe when you're buying a property, if you don't understand the tenancy laws, you think, oh, this is rentable, looks great. But if you don't understand the tenancy laws, you could be up for thousands or even tens of thousands in upgrades you need to do just to get it to rental status.
Yeah, we were recently looking at a property in Victoria, and the selling agent said, look, even though it's got a tenant in there, as soon as it settles, it's your obligation now as a landlord to make sure there's an air conditioner in that main living area to keep that place really cool for the tenant. So a lot of people not being aware, they're buying into a place, and then different states have different regulations. You move to the West Coast and you've got RCDs, smoke alarms, locks, lights, just the basics. And you go maybe to a Victoria where you've got a 14-point compliance plan, which has annual and biannual checks to get done. And not only that, you've actually got a state government that's vested in making sure every property is compliant, because there are fines associated with that. So it's going into it with your eyes open. It doesn't mean you rule those areas out. It just means you're mindful of what you're buying, and does that suit you as an investor? And
some of the other costs too. We're all used to council rates and water rates, so that's pretty standard across the country that the owner of a residential rental property has to pay. But land tax is quite different around the country. So for example, as we mentioned, in Western Australia, you don't pay any tax on a property up to the first 300,000 of land, and the land doesn't include the buildings. But in Victoria, it's only over 50,000. And so that means you, in a normal investment property in Victoria, you might get slugged maybe 2,000 or 3,000 in land tax that you haven't budgeted for, versus all in WA it might be closer to zero or maybe just a few $100s. I think it's also that investment structure too. A lot of states around the country with the land tax sting you from $1 if you use trusts. So I think that's just a reminder to people before you go into state, making sure you run your structure past your accountant or advisor before you go and buy that property, because you could get stung a bit more land tax.
Yeah, and you look at that overall holding costs. The amount of investors that see us that said, I need this 4.5% or this because I'm putting this much money in myself every week, they quickly forget the council rates, the water rates, the requirements for maintenance that every property has, the compliance holding costs that are there, and the fact that your property may be vacant for a couple of weeks every year between tenants. So if you're not budgeting for that and you're not calculating that in, all of a sudden you're left on the back foot and the investment experience isn't enjoyable as it could have been had you gone into that with more information, really.
Having said that, one of the upsides of the land tax regime is in all states they tend to add on your land, and it starts to get very, very expensive. If you keep buying in your own name and you start to get a portfolio in your own state or a particular state, whereas if you invest in another state, you go back to $1 when they're assessing land tax. So a lot of complexity to it, but making sure you get that structure right and know exactly what it's going to cost you before you go into that investment.
Yep.
Yeah. Robin, look, people do worry about, I've got an investment property in another capital city. I can't drive past it. I can't see it all the time. How do I know it's not getting trashed? How do I know it's going to be okay? What would you say to someone who's got that fear?
It's a very normal fear to have. When you see something that becomes real, it becomes safer. So aligning to people that are recommended, people that can look after that asset in a matter like it is their own place. If you have a great relationship with your property manager, potentially an accounting firm or just any professional partner that you may have there, your ability to check on your investment becomes something you can do every 6 months, every year, and that can provide you that degree of safety. Those routine inspections that you get, they're important for you to look through. You look through those assets to see how is it going, how are my tenants looking after it, is there any maintenance that's coming up, is anything in my property looking really tired? But apart from that, Google Earth, you can walk down the street, you can actually research what developments are happening in the area, you can be part of owner corporations or strata corporations where you can sit into the meetings for those regular annual general meetings, but you can do that anywhere in Australia. So being involved in your investment is crucial, that you no longer have to be part of it. So as long as you as an investor is interested and active and have people you can rely on, it doesn't have the same fear as maybe 10, 15 years ago when there was a lot of more trust involved.
Yeah, and I think importantly, we sometimes forget to mention when we're talking about risk mitigation, there is landlord's insurance, and certainly I know a lot of our clients take out landlord's insurance. Now, it's not going to cover you for wear and tear, but it is going to cover you for any catastrophic damage. So if the tenant trashes the place and it's $100,000 to replace all and fix it up, you're going to be generally covered by insurance, aren't you?
That's correct. So you want to make sure landlord protection insurance is there. You want to check your building insurance. Does your building insurance cover contents as well? A lot of landlord insurance actually doesn't cover the contents within it. So your carpet gets damaged, well, the tenant hasn't got insurance on that, so that comes part of your building insurance. So looking at those sort of things, and then ensuring the company that you're working with has professional processes in place. If you have maybe you get what you pay for, maybe you get something that's quite good value, but the property manager doesn't really follow process as well, doesn't breach tenants as well, and before you know it, the tenant's racked up a large bill. Well, part of that insurance is making sure your tenants are getting breached at the correct times. So having a professional property management company, or if you're managing it yourself, ensuring that yes, you may like your tenant, but your obligation is still to breach them if they are in arrears, and you can do it in a nicer way, but that means you're still not holding yourself at the end of the equation going, well, look, I won't get insurance now because I didn't follow steps A, B, and C to be entitled to it.
And look, you can't get rid of risk, it's always going to be there, but certainly by having landlord's insurance and making sure you're working with a good firm who's going to get a quality tenant in the first place, they're at least ways you can mitigate it. You can't get rid of it, and it's really no different to being at home. The only difference is you can drive past it in your own capital city. You can't in another state, but as you said, there's tools out there they can keep an eye on it. So what have you seen some mistakes people have made in diversification? What sort of mistakes have you seen people make?
When they're diversifying without understanding what they're doing. So tools and research is great, but it does also supply a lot of information. If you Google a certain capital city's top 10 investment suburbs, where's that data coming from? It may be that that data is just for the last couple of years when everything's performed well. So it doesn't give you that broader picture. Go like, is this actually a good area to buy in? What type of tenants are renting in this area? What projects are happening around this area? And then for that investment place as well, what other amount of other investment properties are there? If you're buying into an area where 60 to 70% of the suburb is already tenanted, that's a huge portion of tenanted properties that could be susceptible to more properties coming on the market. So your ability to get a return when there's 30 others just like yours on the market at that time starts to diminish when people have that competition. So prospective tenants can look around and go, well, look, this is the nicest one and the cheapest one, I'm going to go for that one. You as a landlord, you want to ensure you're buying in a marketplace that doesn't have an oversupply of investors. It does have a nice choice. Families want to live there. So you're able to get into a market that's giving you, I guess, what you're after for longevity, lack of turnover, and a bit of a stronger position where potentially you can put the rents up, because when it's due for a rent increase and people can afford the rent increases, it's more likely to happen. If people are buying in an area, and unfortunately we do get this a lot in our marketplace, they come to see us with a preconceived idea of these are the 5 suburbs I should be buying in because my friends have bought there or I've been told to buy there and they've done well. Well, certain marketplaces, everything has increased, but the rates of increase differ. So just because your friend made $100,000 in that marketplace in the last 2 years doesn't mean that you will in the next 2 years, and it doesn't mean that that area is going to continue to perform at that basis. So it's speaking to people who understand marketplaces, and that is unfortunately not always the selling industry. The seller industry and selling agents, which I used to be one myself, we used to know our marketplaces. We know them very well. But then as soon as you ask a selling agent, what about this area? What about that area? And they're not familiar with that. They're not selling properties in there. You're not getting a balanced equation. So speaking to people who understand dynamics of the whole city is important as well.
Well, that's right. Selling agents, they're getting paid by the seller. Their goal is to sell the property, and I've not heard a selling agent say this is not a good investment. So you've got to understand that when they're giving you advice that they've got a vested interest in looking after the seller, which is fair enough again. Also on the point of, you mentioned there, capital growth. So if you go diversify into another capital city because it's the right time for your portfolio, clearly you want to buy into a market where you think there's some growth opportunities, not only long term, but it'd be nice if there was a short term uplift. Of course, that's still the long term's the most important. But choosing those suburbs, I mean, I've seen it time and time again around the country. Poorly performing suburbs over 30 years might have done 300% to 400%, and in that same capital city, I've seen suburbs do 1,400%, 1,500%. So it's not just about choosing that right city at the right time, it's that suburb's still critical, isn't it?
The suburb's critical, the drivers within that suburb's critical, and then quite often the better the capital growth, the lower the rental yield is. So being mindful, what is my rent return going to be when I'm exposed to this capital city? Every capital city has differing yields. So from the top to the worst, you've got to find out, well, the average I'm getting is this much per rent. What is it going to cost me to hold this asset? What is my buffer? And then, as you said, the capital growth is absolutely crucial. So a lot of investors do want that sort of blend of both, and then buying in an area where owner occupiers are still going to want to live there. There's not an oversupply of rental properties currently available within that. And then even within those suburbs, finding those best streets, best locations, the best ones with zoning, the ones that are going to get you the better return within that, because even suburbs don't all perform the same rate. If you're looking at a suburb and that suburb's gone up 12% in let's say over a year, not every house has gone up 12%. Some have gone up 15%, some have gone up 5%, but the median was 12% for that particular suburb. So finding the best ones within those ones are crucial, and exploring the whole marketplace. Giving you ultimately, ideally, a tenant that's going to afford your rent, look after your property. You're going to want to keep them there. They're going to want to stay there, and that makes your whole journey as an investor so much more enjoyable.
So when should investors think about diversifying their property portfolio? Is there a right time, or is it going to be different for each investor depending on where they are?
I would say different for each investor to do with their risk tolerance and how many assets they may be exposed to in one marketplace. So for one investor, they may have 2 in Sydney, for example. It might be the perfect time to get into maybe a Brisbane or a Melbourne or a Perth or an Adelaide to decide what's right for me. Other people may feel more comfortable and go, no, I know this marketplace, I like it. Anything else, it's going to be at the back of my mind and it's going to create stress for me. So first, finding out the risk tolerance. After that, I think if you've already got 2 or 3 assets in one capital city, I think it's a good time for you to actually look and go, where else could there be growth? Because this won't always be the place to be, or just because this place is quiet doesn't mean it will. We can get in there knowing we're not going to make that much money for the next year, but then that place is due for its next run in the cycle. So we're buying it with a long-term perspective, knowing that, yes, this marketplace is rising, that's stagnant, we'll get another one here. So when this one slows down, that one picks up, as we said earlier. And yeah, set 2 or 3, I think that's when you start posing that question to the trusted advisors around you. Yeah,
and we've been speaking about residential property today, but of course diversification in your property portfolio can also mean commercial, can't it?
Yeah, commercial is absolutely excellent, and it's got to be, your book explains it so well, is when the right time to go into commercial is, and also what is your budget for commercial. When people look at diversifying commercial, not everyone, and the majority of people, can't afford to buy the right style of asset, in my opinion, that is going to be the right one for their portfolio. They might go, look, I can spend $1 million on a house, or I can spend $1 million on commercial. What can I buy? And $1 million commercial asset, it may sound good, it may offer great things, but then there's also downsides to that. So it's how do I find the right investment when it goes to commercial industrial? And I think that's where, you know, what you do with the Westbridge side of it is excellent, where people can look at their overall return and how do I blend in the commercial, industrial, medical, office, whatever you choose to have in that portfolio with the residential. So what would your take be on like the blend to get you that good yield?
Yeah, I think it's certainly commercial property on the surface looks very appealing when you can get 6 or 7% net returns. And as we know in residential, after you pay all the expenses, without debt, even before debt, you might be getting 2%, maybe even less in Sydney and perhaps a little bit more in some of the other capital cities. So commercial property does give you that higher income stream, but it does carry that higher risk in terms of the tenant. If the tenant goes out of business, in commercial, you can sit vacant for years. Whereas in residential, if your tenant leaves for whatever reason, generally, unless the market goes particularly bad, which is very rare, you can generally get a tenant within 4 weeks, worst case, maybe 2 months, if you adjust your rent. So different, not quite apples and apples when you're looking at them, but the really important thing about commercial property is the ability to diversify, and I'll get to that in a second, but also understanding before you go into the commercial market, the asset classes perform quite differently, and we've seen that over the last decade. Industrial properties perform particularly well. Some retail formats that are part of the future of distribution have done pretty well, but office around Australia for a long time, and particularly in the last couple of years, has been hit really hard. There's been assets that have sold less than half the value that they were purchased. So it does come with more risks, and you've got to understand the asset classes. But one of the great things about commercial property is the ability to go into funds. So there's not really any or many residential funds around the country. There's a small handful, and this hasn't become popular. People like to invest in residential in their own name because they can borrow and buy that asset as theirs. But in the commercial world, there's a lot more people who invest through a fund, and that's where they're basically buying into. You might buy an asset for 40 million, for example, might be 20 million of debt, 20 million of equity. Keep it simple. If you put in 200,000 into that particular fund, you own 1% of that asset, being 1% of the 20 million in capital. So you get 1% of all the income, and you get 1% of all the capital gains that accrue to that. So I think it's an important thing for people to understand in commercial, because the sticker price can be very high. You know, some assets are very expensive. You can still get exposure to that through a property fund manager, and by diversifying that way, you could, if you had $2 million to invest in commercial, potentially you could invest, you know, as an example, in 10 different funds, and those 10 funds might, in themselves, some of them will have multiple assets across the country, not only just in one city. They'll have multiple assets and multiple tenants across the country. So if you're $2 million, you could either go and buy one single asset, it could be an office or a retail shop, relying on one tenant, relying just on that property. Or you could get exposure to potentially 30 to 50 properties and diversified across the country, and maybe 30 to 50 different tenants as well. So it's much easier to diversify within the commercial space simply because there is those property funds. Far harder in the residential space because there's very few and far between of them. And also we see people like to buy residential on their own. They like to touch it, feel it, their names on the title. So do you find any more clients thinking about commercial property in their journey?
I find that a lot of people will gravitate towards what's comfortable, what they know, what everyone else knows around them, which is residential. And as you said, it gives them the ability to scale by they've made this much growth on that, they can then leverage that for another one. I find that when people are approaching the end of their journey and they still want to have the cash flow, they're starting to look at other options and going, well, look, if I do get out of my maybe 2 or 3 of my residential properties, put that asset into something that's going to provide that higher hands-off return, they can enjoy their life a lot more, getting that stable income coming from that commercial industrial. They've still got maybe 1 or 2 residential properties that's sitting there, but it also means they're free to actually travel and maybe enjoy their retirement a little bit more, rather than having that hands-on approach where they're actually having to go, look, tenants are coming out, what's the rent going to be? I have to spend money on this. So you need to become available all the time for your property manager and for your tenant to make sure you get the best out of that asset. If you've come to the end of your investment journey, you actually probably most of the time want to enjoy life a little bit more, travel, spend time, and that's where commercial industrial provides that hands-off approach. So my experience, as people start to approach sort of 50, 55, that's when they're looking at how can I diversify more into something that's going to give me that regular income without the hands-on approach.
Yeah, and our philosophy is generally 50% of commercial is the target and 50% residential. That way you're going to get somewhere between around 4.5% net return. And if you've got good quality assets in your property portfolio, whether that be commercial through a fund or whether that be residential, that should grow at least in line with inflation, as well as your rents, giving you that property income for life. And you know, just in simple maths, if you've got $4 million of net investment property, sounds a lot, but if you start early enough, it's definitely achievable. Or you buy the right assets as well on that journey, even if you start later. That's $180,000 a year. And that's without dipping into your capital. $6 million is about $270,000 a year. But the good thing is you don't have to keep all those assets necessarily. You could maybe, if you don't get to quite those sort of levels, but you've got some equity in your properties, you might sell one. You might sell one for $1 million, and then instead of $4 million, you've got $3 million. You're still going to get to 145,000 or thereabouts, 150s, around that range in income. But also you're going to get, with that capital that you've sold down, that mean you can live on that property for another 10 or 15 years on top of that. So great thing is having lots of investment properties gives you choices. Having no investment properties or no investments doesn't give you much choice at all, does it?
Yep, you got to start well with the first one, as you said, and if you can do that right and plan your journey ahead of you with a long-term perspective, your end goal is going to be what you really want, which is that comfortable retirement.
Yeah, and importantly, as we've discussed earlier, but just something to reiterate to the listeners and the viewers, is that everyone's journey is different. There's no perfect way to get to the end goal. The end goal is living on the income from your property, ideally, but everyone's journey is going to be different, isn't it?
Correct. Yep. What your friends are doing, what other people are doing, that might be perfect for them, but that doesn't mean it's going to be perfect for you. So finding out what's right for you and what will help you hold that asset for the long term is crucial.
Robin, thanks for being here. Great discussion today.
Cool. Thanks, Damien.
We've covered why diversification matters, how it can protect you from market volatility, and the practical ways investors use different locations, property types, and strategies to build stronger portfolios over time. And remember, successful property investing is not about chasing the next hot market. It's about building a balanced portfolio that works together to support your long-term goals.